So, Darcy, what do we say? What do you think about inflation lately?
I've been thinking about inflation a lot lately. A lot, probably since 2020. I've been thinking a lot about inflation, and what we're seeing right now, I think, is a little bit of a come to Jesus moment in terms of ideological paradigms diverging, in terms of like understanding why inflation comes to exist and how do we treat inflation, and is inflation really what monetary policy is there for? I think there's some really honest questions that we need to ask ourselves, not because there's a deep, dark conspiracy theory going on, but because I think the world is probably at a place right now where inflation is probably going to be I guess, the least worst thing to worry about.
Yeah, and I think there's actually some positives on the horizon, which we'll get to as
I
well,
think
which
so.
you've kind of alluded to earlier in our previous conversation.
Yeah.
But 2020 was an interesting year because I think you might have called it as well, that stagflation, you could almost guarantee that stagflation was going to be an end result,
Yeah.
right? And for a while nobody really seemed to want to say to stagflation, right?
That's right. And I think even just saying that there would be some form of inflation as a result of policy decisions was almost like you were labeled a conspiracy theorist because you were kind of saying, hey, what they're doing is not necessarily the right decision.
Yeah.
And it's only actually been recently where being critical on central bank policy from that time has been kind of acceptable to come out loud and say that. Whereas I think the standard answer was, well, in that situation, what were we going to do? We were worried about a global depression, right? But now we're in a situation where we're now worried about a global recession, potential depression as well. So we're there anyway. And largely, I'd suggest it's because of intervention, and intervention doesn't actually protect us. It makes things worse.
It does. And I think in defense of the central banks, I think that definitely were enablers, but it was probably the only thing you could do if you thought that we were going to shut the whole economy down.
Mm.
But at the same time, without the central bank intervention, the government wouldn't have had the choices on the table
Potentially.
to go to basically get as deep into it as they did, right?
Deep is a good word, because I think it's hard to have a really good conversation without going down a few crazy rabbit holes in that one, because I think that there was a lot of what happened in terms of government and central bank responses, which I think were there's a lot to unpack around that, and I think to sort of kind of skip over it's probably not a bad idea in the interest of kind of like the big picture is that they were instrumental, rightly or wrongly, justified or not, they were instrumental in creating the type of inflation that we're still dealing with today.
In an environment which is really stagflation. Let's face it. And the thing is, now we've got oil tankers which are probably not heading slowly to us, which on the horizon you would go more stagflation, right? However, we're not just going to dwell on the negatives, because you're surprisingly positive on some of the things, which I've also thought about, which is there's a lot of other things going on, right? We've got technology changing the game.
That's right.
And I think if we think about the early 2000s, maybe it was globalization back then or whatever it was, but for a while it felt like whatever you did, you didn't get inflation.
Yeah.
And in some sense, it was this interconnected globe where we were making productivity, we were spreading our resources much more efficiently globally.
Yeah.
Through globalization. And maybe that was part of low inflation for us. In some ways, we were maybe exporting inflation.
Yeah, because somebody else could make it overseas for way cheaper, lower input costs over here, keeps a lid on rising prices.
Yep. And in some sense, AI is put that on the table for us.
Yeah, I think so.
Some of our responses to higher oil prices is really, there's going to be a bit of demand destruction. I'm not buying 80 litres of diesel anymore with my EV.
Oh, I park next to you outside with the EV, I think.
Yes.
There's like 3 EVs in a row, right? So it's like, yep, somebody saw it coming.
So so the thing is, at the back end of this, we're not going to be as reliant on.
So true. And that's a good thing, right? Sometimes rising costs like rising input costs is necessary. Like pain is sometimes good.
Necessity
Right.
breeds invention, right?
Exactly. And so you've solved a problem because the free market is delivering higher prices, which then causes your behavior to change. And this is going back to 2020. Like if some of that pain were to occur,
Yeah.
arguably, I'd say some of the problems that we're dealing with today would still be there, but I think we would have solved some of them.
We would have moved a lot quicker
I think
away
so,
from it.
because we're not building resilience every time we appoint other either political or financial authorities to rule over us. We're not solving problems. We're trying to access comfort today, and every time we seek comfort, we're actually not learning the lesson that we need to. We're not advancing a cause, and you can't say, "Hey, we're going to mandate adoption to green renewable technology," and then expect the world to change. That just creates inflation.
Correct.
But if you allow higher energy prices to go through the system at an individual, I'm not saying this is good necessarily. It's going to be painful.
Yeah.
But if you allow higher fuel prices to permeate throughout the system, you're going to see the free market forces, if they're left alone, allocate resource better. And I think you're going to see inventions and you're going to see innovations, especially in New Zealand, which will start solving these problems.
Yeah, because New Zealanders are a very resilient bunch and much more resilient after 2020. And in some sense, I think, we keep hearing about the productivity woes, Darcy.
Yeah.
What are your thoughts around the future for productivity?
Yeah, again, I'd be really optimistic, especially in New Zealand. We have a huge wall of businesses that are going to either be shut down or transferred to the next generation. I think a lot of those businesses, especially those that do or make things, pre-AI businesses, pre-robotics businesses, represent phenomenal opportunities to actually build wealth as a business owner, but also as an economy. Again, if the free market was left alone to innovate, kind of like what you were saying before, the natural inflationary forces that we have to deal with now because of rising energy inputs can kind of be absorbed within this technology layer, because like in the past, how we would send it over here so that cheap labor could send our shoes back.
Right.
We're kind of putting our needs now into AI, into technology, and we're getting input back, which is infinitely cheaper, which then keeps a lower cost for businesses, right?
So really a couple of big positives on the horizon. Of course, there's going to be a painful period. There's no getting away from it.
Very painful.
If you're an investor and you're thinking about putting your money into property or funds of some sort, right?
Yeah.
Well, I'll come to property second, but I'll let you get your thoughts on investment in terms of funds. Because I think you mentioned earlier around, it's simple just to go, I'm just going to buy AI stocks. But actually there's a bigger picture, right?
Sure.
In terms of data centers and then there's...
Totally. Yeah, absolutely. So like if you kind of trace it all back to kind of think about where we're at in the world right now, you trace it all back to where it's kind of come from, I would, there's a really cool old school economist called Joseph Schumpeter, who is an Austrian economist, and he coined this phrase called creative destruction. And it's when something new comes on the scene, like a technological innovation, how it ushers in a benefit, but at the same time, it creates a lot of pain and destruction. And I think what the world is going through right now in various ways is a form of creative destruction at a mass level. And a lot of it could be traced back to technology. Some of the financial instability, trace it back to that, how central banks are responding to technological changes. They've always responded to technology, which is deflationary in terms of increasing our purchasing power, by creating new currency through lowering interest rates artificially. And that credit expansion absorbs the productivity gains that technology can bring. So everywhere you look, you can see this impact of rising or more and more technology creating this mess.
Yeah.
And so when we think about an investment thesis, how do we benefit? How do we take that negative, manage that risk, and scrape away the positive? There's a couple of things. I'd look at AI is just the latest iteration of technology, but pre-AI businesses, pre-robotics businesses, around the periphery of AI as well. You can go straight for the jugular with NVIDIA,
Yep.
but just do a bit of research first around what happened in the .com crash. sometimes
Not everyone's going to win, right?
it's impossible.
Yeah.
And it's waves of innovation.
But whoever wins may still pick up the old data centers, for example. And
True.
then the data centers might still require air conditioning.
Absolutely. And energy and cooling. And like there's second, third order things that you can invest in and be quite strategic.
Yeah.
Whereas a lot of people, when they're investing in funds, for example, they're investing, say, in the S&P 500, like a good chunk of what they're investing in is one company, NVIDIA. And great if NVIDIA keeps on performing well. And if you look at the performance of a lot of KiwiSaver funds, if they have a high allocation to the S&P 500, well, some are basically just repackaging that, let's be honest.
Yep.
You're really just investing in one company in terms of your most concentrated bet.
Yep.
And then everything else is kind of minor to that. So if you had really good performance, it's because of that single theme. But the greater your investment returns and the more variable they are, the more likely you're going to have some down years as well. And so I think as we form an investment strategy, you have to be quite strategic. And I think the idea of passive investment, while it makes good sense at a level, I think we might be entering into a new regime where active management, where you're actually thinking about these dynamics and taking like deliberate positions in them. I think that could gain more traction again, because I don't think it's enough to say, hey, we're going out fishing every single day without looking at the weather. And I think the weather's changing.
So I think what you're saying is, in some sense, think about the support structures that AI needs.
Yes.
As well, and think about the businesses that will change dramatically because of AI. Look, in terms of property investment, which is my field, as a mortgage advisor, we peddle debt. So
you debt salesman.
I love leverage, right? So
same here. I love it. Bring it on, man. Bring it on.
So I mean, I'm bewildered every day that you have this environment where there's high inflation, and then you're looking at a horizon where there's more high inflation. So everything's going up, but houses. Yeah. And I don't think that's sustainable, right? Because the planner, the architect, the framing, the wood, the nail, the hammer, these things have gone up. Yeah. And so if I'm picking up a structure with land that's cheaper than it was, or around the same as before all this inflation, how is that possible? And whenever I've seen that in the past, and I've been around a while, Darcy,
Don't let the good looks fool you, man. Don't let the good looks fool you.
You still got here.
I'm hanging on, man.
So, I have, whenever I've seen that kind of sweet spot where I'm like, hold on, this doesn't make sense. This house here seems way cheaper than what I could produce it for.
Correct. Yeah.
Way cheaper, and includes the land. Yeah. Then usually within a few years, it seems to correct itself. Correct. And the correction is the price has to come up.
Mean reversion, yeah.
I think the other thing is, of course, we're going to have possibly more inflation. So with inflation, effectively, you erode the value of money, but you erode the value of negative money, right? So your debt is becoming lighter in some sense. To get through to the other side, though, you've got to deal with high interest, right? So again, cash flow becomes important. So if you're buying property, think cash flow. Right? Unless you are in a field where you've got tons of cash flow banked in, you can't lose your job. Let's say I don't know, in this country, maybe a doctor or what else?
A mortgage broker.
We're always walking a fine line, but so you have cash flow is important. So whatever you buy, if you're taking debt, if interest rates do go up, I've weathered many storms before, I've got some property and even with those interest rates hitting 7%, I was able to get through without having to sell. And that was because they were not in the nicest areas, Darcy, but they had good cash flow from day one. Yeah. Right. So that's one way to go about it. Also, if you're thinking about the future and the future's looking a bit bleak, think about your structures and tidy them up. Get your facilities on track, stretch your terms. If you're disciplined with money, stretch your loan terms, get your cash flow looking nice and strong. Before we get into a next round of interest rate increases, if that unfolds, right, Darcy? Because we're quite unique in that we have a different view that there is a chance that if things really get bad, do you think interest rates will keep going up?
Let's talk about that, shall we?
Yeah,
definitely. I like what you were saying though about the you can buy a pre-existing home at the moment for less than what it would cost to build it. And I think the reason, well, I wonder about the reasons behind that, but I think some of the reason is because of the financial system that we operate in that banks are lending towards the purchase of these things. So banks are directly and indirectly controlling the value of them because they're controlling the cost of the money used to borrow to buy those things.
Yeah.
And so banks do control house prices. Let's be really blunt, right?
Yep.
Because
Credit growth is
credit growth, number one determinant, right? Everything else is probably secondary to that. And then you have this inflation thing, which increases the cost of the nail, the hammer, the wood. But I think what we're going to see in the future, like if we think about inflation, CPI, Consumer Price Index, and you think about that basket of goods, we have services, we have goods inside that basket.
Yep.
Some of those things are going to get infinitely cheaper, I think. And I'm talking kind of like these glasses, right? I can kind of see within a certain range, but I can't see beyond that. So I'm talking about things that might materialize, say, in 2 to 7 years rather than immediately. But I think we're going to see reduction in prices and a lot of the cost to build that house. But I think we're going to see at the same time an increase in cost to do with things that are what I would call controlled sectors of the economy. Things where there's council approval, there's red tape, there's regulations, there's constructs that come from humans, whereas actual goods themselves could be quite cheap. And so I kind of wonder what those dynamics will look like when you look at the cost of buying a pre-existing home versus building a new one in the future. So that's one aspect of that. But yeah, just to touch on your question around the interest rates, I think that a lot of the bank economists, and especially the bank economists that might be owned by an Australian bank, which may be coming from a slightly different commercial paradigm than, say, local banks, I think there's two things going on. There's a commercial incentive. There's also an ideological bias, Keynesian economics specifically, which would suggest that governments and banks can and should intervene in the economy to smooth out the ups and downs without acknowledgement that actually creates the ups and downs. But number two, that means that every time you see inflation, you have to act.
And have high interest rates.
I think.
Well, I think
right now we don't.
To the credit of the banks, Darcy, because they pay for me.
I know. They don't pay for me anymore, so I'm way more critical.
I know you are. No, but I mean, I think some of the economists, maybe they're just too young, Darcy. Is that
maybe?
Because, surely they realize with stagflation, you can't fix it with high interest rates.
Yeah, maybe. I think it's really easy to kind of get anchored on a narrative, and like I'm no different. Like if you and you would be the same, right? Like if you look at a mirror and you're on the other side of it and it's a one-way mirror, you're going to see more than the other person does. They're only going to see their own views. But you've got a one-way mirror too. And so I think no matter which side of that coin or that mirror that you're on, you're going to get anchored into your own set of views. And you kind of have to hold both of these things in tension. And I think a lot of the bank economists, if anything, are at risk of slipping too much into a groove of an ideological bias where they get certain derangement syndromes. They'll get anchored on an old Keynesian narrative, which they would have learned in university, which every central bank subscribes to, every bank economist subscribes to this, more or less. And it's really difficult to kind of adopt a view or a model which responds to reality.
I think you touch a really good point there, which is reality. And I'm not an economist, but from my very basic understanding, the way I see it is that the central bank would like to have credibility in the currency, so they don't want a lot of inflation. But if the fabric of society starts to disappear, that's more pressing, because who cares about currency if the whole infrastructure of being able to supply goods and services disappears? And I think with this crisis, with the way it is, if things go really bad and we don't have diesel tomorrow, I don't think the central bank, what's the point in reacting with high interest? I just don't see it.
Exactly. And if you were a household, would you really, like, apart from the fact that you need diesel to get around, would you really differentiate between a higher mortgage payment versus a higher energy bill? It's just higher cost. You're going to adjust your spending regardless.
Yeah.
you can't really do much when your interest rate goes up, apart from sell your home if you really had to, and then go pay rent, but your rent's going to go up as well because that landlord has a mortgage too. With higher energy costs, you can adapt your behavior and you can adjust to that. So you can kind of look through some price increases and you can't look through others. And so I think a lot of what it is that it's almost like, I'm not saying this is true, but it's almost like they're adjusting interest rates to respond to forces that are more in line with retaining their credibility than they are about actually doing anything meaningful.
To be fair, though, we have a new Reserve Bank governor.
And she's different.
And
Yeah.
she's different. And I think so far, I mean, there's been some good response. I think everyone feels like, she's pretty onto it.
I feel, to be honest, I like her. I'm not like in love with her, don't get me wrong, but that would be a tough, weird thing. But I think that.
Would it though, Darcy?
Well, yes, it would.
You're married, right?
Yeah, I am. But we're going, do we edit this or not? No. But yeah, I think towards the tail end of last year, we saw certain bank economists calling for higher interest rates. In my view, they were talking markets up.
Yeah.
I think they were successful. We also saw our new central bank governor come out in kind of an unusual way and reassert that basically they were in charge of where the OCR was going, not the trading banks. We're still seeing that now. And it's almost like they're taking turns with the same narratives that we're going to see OCR increases this year. I think that's incredibly irresponsible. And I think that as much as we shouldn't inform our financial decisions from social media and what we read and what we listen to, a lot of Kiwis do. And I think a lot of Kiwis are fixing their mortgage rates for periods of time that are more informed by these views and these incentives rather than reality.
Then leaning on their financial advisors. And
exactly.
The importance of financial advisors, Darcy, I'm going to say is that we pick up the phone, right? We know it's not always going to be pretty, but sometimes we've got to be objective and look at the woods, but the forest from the trees, and look at the bigger picture. And the bigger picture means, I think, is that there are things you can do in your own personal circumstances, which is very important to your financial future. Macroeconomics and broad principles don't always mean that much to you, right? So I think that's where we come in as financial advisors. So
well said.
That's a little bit of a plug for us, I guess.
I mean, that's really important because you're where the power gets put down. You know, like somebody's reading the news, listening to social media, even hearing this conversation, they might think, oh, I need to do this, I need to do that. But unless you actually talk to somebody external to your circumstances and you put it into context and you form a strategy that speaks to that, you're just being led by the various currents that you're exposing yourself to, this fire hose of information and social media. But you could pick up the phone, talk to somebody, understand their circumstances and say, actually, because of the fact you're going to be selling in 2 years, don't fix for 4, you know? Whereas they might be thinking, interest rates going sky high, I need to lock it in for 5 years.
What I like to say sometimes, Darcy, is that I can't tell if 2 months from now on a Saturday whether it will rain, but I know that if you put a big enough marquee up, that it'll be dry under it. And with that, we're going to close it off. But as financial advisors, things might get a bit stormy, but we're going to do it together, right?
Well said. Good.
Thanks, Darcy.
You're welcome.
Awesome to have you.
Thanks for having me on.
Yep.